The story begins and ends with one man, yes, this man, John Law. You may call him a philosopher, an economist, a financial engineer, a fund manager, a banker, a finance guru, a villain, a hero, or even a murderer. John Law was born in 1671 in Edinburgh, Scotland, into a family with deep financial roots. His father was a goldsmith who also engaged in banking activities. Law inherited this legacy at a young age, and by his early 20s, he was living a lavish lifestyle in London, characterized by gambling, fashion, and socializing. However, his life took a dramatic turn when, at the age of 23, he killed a man in a duel, leading to his imprisonment and a death sentence. After appealing the verdict, Law managed to escape from prison, leaving his old life behind and embarking on a journey across Europe. It was during these years of exile that Law delved into the world of economics, setting the stage for his later ambitions that would leave an indelible mark on financial history. To fully grasp the complexities of the Mississippi Bubble and John Law's pivotal role in it, it's essential to first understand four key elements of his time. The nature of
1. Nature of money. In John Law's era, money was predominantly in the form of gold and silver coins, known as specie. These coins held intrinsic value but were cumbersome to transport and manage, especially for large transactions across distances. To facilitate easier trade, people began using paper receipts issued by goldsmiths who safeguarded their coins. These receipts, representing the value of the stored gold or silver, gradually became widely accepted as a form of money. This shift from physical coins to paper marked the early stages of modern banking, as it allowed for more efficient and secure transactions, laying the groundwork for the development of paper currency. 2. Credit. Credit played a pivotal role in the economy by enabling individuals and businesses to engage in transactions without needing immediate cash. Tools like promissory notes and bills of exchange became essential in facilitating trade, allowing people to buy goods and services with the promise of future payment. These instruments could be traded much like money, effectively increasing the liquidity in the economy. By allowing transactions to occur even in the absence of physical currency, credit accelerated commerce and economic growth. However, it also required a system of trust and regulation to ensure that debts were honored, which eventually led to the more formalized banking systems we know today. 3. Banking system. The early banking system evolved from the practices of goldsmiths who, beyond just storing gold, began issuing receipts and lending money based on the gold deposits. Over time, these goldsmiths realized they could lend out more money than they physically held in gold, relying on the assumption that not all depositors would withdraw their money at the same time. This practice, known as fractional reserve banking, significantly expanded the money supply and made it easier for people and businesses to obtain loans, fueling economic growth. However, this system also introduced risks, such as the potential for bank runs, where too many people would attempt to withdraw their deposits simultaneously, leading to bank failures if the bank couldn't cover all the withdrawals. 4. Government debt. Governments in John Law's time frequently borrowed money to fund wars and other large expenditures by issuing bonds, which were essentially promises to repay the borrowed amounts with interest. John Law proposed an innovative idea, converting government debt into banknotes that see. This approach initially worked well, as it provided a new, more flexible form of currency that stimulated the economy. However, the system began to unravel when too many banknotes were issued without sufficient gold to back them. This overissuance led to inflation, as the value of the banknotes decreased, eventually resulting in a financial collapse. Law's experiment highlighted both the potential and the dangers of tying currency to. In 1715, France was in deep financial trouble after King Louis XIV's long reign ended, leaving his 5-year-old great-grandson as the new king, with Philippe II, the Duke of Orleans, as regent. The country was drowning in debt due to decades of war, an inefficient tax system, and widespread corruption. Taxes were collected through a privatized system where leaseholders collected indirect taxes, and direct taxes were managed by buyers of public offices. Despite these efforts, the government couldn't cover its expenses, forcing it to borrow more, often defaulting on debt when politically possible. France's banking system was underdeveloped compared to the Dutch and British systems, making borrowing difficult. The shortage of money and a broken credit system left the economy stagnant. John Law, who had previously visited France and proposed a land bank scheme, was brought back in 1716 to help solve these problems. He believed that the lack of money and credit was hindering economic growth. Law's solution was to establish a bank that could issue paper money, which he thought would boost manufacturing, agriculture, and trade by making credit more available. Law carried out 3 steps to tackle the issue. In May 1716, John Law established the General Bank, Banque Générale, to address France's economic problems by increasing liquidity and restoring confidence in the financial system. The bank was initially a private institution with a modest capital of 6 million livres, L, raised by selling 1,200 shares to the public at 5,000 L each. However, shareholders were only required to pay a quarter of the price up front, with the remainder to be paid later, allowing many to participate in the investment. The General Bank was authorized to accept deposits, discount bills of exchange, and issue banknotes backed by specie, precious metals like gold and silver. These banknotes became popular because they were guaranteed by law to maintain their value, redeemable in the same amount of metal as when issued, thus protecting against currency debasement. The bank's notes were quickly preferred by the public over other forms of currency because they were more secure. By January 1717, the General Bank had become well established and highly profitable. Its credibility grew even further when, in April 1717, it became the bank of the government. The bank's notes were declared legal tender, meaning they could be used for tax payments and other government transactions. In December 1718, under Law's influence, the bank was nationalized by the French regent, who purchased its shares and renamed it the Royal Bank, Banque Royale. With nationalization, the bank expanded its operations, but the crucial metallic content guarantee on its banknotes was removed. The second step in Law's strategy was to create a major commercial enterprise that would help consolidate and manage France's debt while stimulating economic growth. In August 1717, Law purchased the Mississippi Company, which held the trading rights for the French colony of Louisiana. He rebranded it as the Company of the West, Compagnie d'Occident, and relaunched it as a joint stock corporation. The company was authorized to establish trade posts, colonize vast territories along the Mississippi River, and engage in lucrative trades like beaver pelts. Initially, the public showed little interest in the company's shares, with prices trading well below their face value. Like the General Bank, these shares were primarily purchased with government paper, which was heavily discounted at the time. However, over time, Law began acquiring other companies and monopolies, such as the tobacco monopoly, the Senegal Trading Company, and the East Indies and China Trade Companies, merging them under the Mississippi Company's umbrella. This strategy formed a powerful conglomerate, later renamed the Company of the Indies, Compagnie des Indes, which dominated not only trade but also tax collection and mint operations in France. To finance these mergers and the company's operations, Law issued additional shares in June and July 1719. To make the shares more attractive and affordable, he introduced installment plans, where buyers paid a small down payment upfront and spread the rest over time. This plan allowed investors to leverage their purchases, significantly increasing demand for the shares. As a result, the share price skyrocketed, with the price rising from 490 L in May 1719 to an astonishing 3,600 L by August 1719, reflecting the public's growing confidence in Law's financial system. The most ambitious part of Law's plan came in August 1719 when he undertook the conversion of France's long-term national debt into equity in the Mississippi Company. France's debt at the time amounted to a staggering 1.6 billion livres, and Law proposed that holders of government bonds exchange their debt for shares in the Mississippi Company. This conversion offered bondholders the opportunity to switch from fixed-income securities, which provided a stable but modest return, to equity in a company promising higher dividends and potential capital gains. To facilitate this massive debt conversion, the French government issued vouchers to bondholders, which they could redeem for specie, royal banknotes, or newly issued Mississippi Company shares. With the Mississippi Company's shares trading at inflated prices due to Law's market manipulations, the conversion was attractive to many debt holders. By mid-September 1719, the Mississippi Company issued 300,000 more shares, raising further capital to absorb the national debt. From the government's perspective, This conversion was advantageous as it reduced the interest rate on the national debt from 4.5% to 3%, easing the financial burden on the state. Meanwhile, the Mississippi Company and the Royal Bank became central to France's financial system. The company's revenue sources included interest on the national debt, profits from tax collection, and commercial ventures like international trade and minting operations. The Royal Bank supported the Mississippi Company by issuing banknotes, extending loans to the public to maintain demand for shares, and ensuring the company's liquidity. Over time, the Mississippi Company transformed from a commercial enterprise into a financial powerhouse, intricately linked with France's public finances. However, this close relationship between the company and the government set the stage for what would later become the infamous Mississippi Bubble, as the system Law created became increasingly unsustainable. After September 1719, the share price of the Mississippi Company skyrocketed, creating significant paper wealth for its equity holders. The surge in demand was fueled by widespread anticipation of quick capital gains, leading people to liquidate their real and financial assets to invest in the company's shares. By October 1719, the share price had reached 6,463 livres, L, and continued to soar, peaking at 10,025 L by December 2, 1719. John Law implemented several strategies to maintain and increase demand for shares. He announced a 12% dividend on the shares, which was far higher than the return on government annuities, and allowed installment-based share purchases, enabling buyers to leverage their resources. Law also engaged in aggressive price management, including buying back shares to prevent price declines and offering loans through the Royal Bank to potential buyers, using shares as collateral. The initial success of these strategies elevated Law's status, and he was appointed France's Comptroller General and Superintendent General of Finance on January 5, 1720. Just days later, the share price reached its peak of 10,100 L, marking a 20-fold increase from the original issue price within 8 months. However, the system's internal contradictions began to emerge. Law faced the challenge of maintaining interest in the company's shares among debt holders, who were required to convert government bonds into company equity. As installment payments became due, some investors sold their shares to raise funds, putting downward pressure on the share price and forcing Law to issue price guarantees. Another significant problem was the unstable increase in paper money. The Royal Bank expanded loans to support share purchases, issued banknotes to cover the company's operational expenses, and provided funds for state expenditures. By the end of December 1719, the volume of Royal banknotes had surged by 92%, from 400 million livres, ml, to 769 milliliters, leading to a dangerously low specie reserve. To prevent a run on the bank, the government took measures in December 1719 to encourage the use of banknotes and discourage the hoarding of specie. Royal bank notes were made legal tender, and the use of coins and precious metals was restricted. Despite these efforts, the system's stability relied on the public's confidence in the bank and their willingness to hold banknotes instead of gold. In early 1720, as the share price hovered above 9,500 L and the volume of banknotes exceeded 1,000 million livres, the Mississippi Company stopped supporting the share price. This led to a sharp decline, with the price falling by 26% from February 22 to 29, 1720. In response to shareholder protests, the company guaranteed a minimum price of 9,000 L in March and resumed trading at this fixed price. However, the money supply spiraled out of control, with the volume of banknotes reaching 2,000 milliliters by the end of April 1720, ultimately leading to the collapse of the bubble. In May 1720, the Mississippi Company, under John Law's direction, assumed control of the Royal Bank. At this time, the amount of paper money in circulation had ballooned to 2.1 billion livres, causing growing concern about the bank's ability to exchange these notes for gold or silver, known as specie. The situation was precarious, with the bank's credibility hanging by a thread due to the overwhelming supply of paper money. To address the issue, Law decided to reduce both the company's share price and the volume of banknotes in circulation. On May 21, 1720, he announced that over the next 7 months, the share price would be gradually lowered from 9,000 livres to 5,000 livres, and the quantity of banknotes would be reduced accordingly. This plan, however, backfired disastrously. The announcement triggered panic among investors, leading to a mass sell-off of shares. Within just 6 days, the share price plummeted by 17%, sending shockwaves through the market. The regent quickly realized the severity of the situation and reversed Law's decision, but the damage was already done. As the crisis deepened, resentment towards Law grew, especially among the old guard of French society, the nobility and financiers who had been sidelined by Law's new financial system. With the collapse of his scheme, these powerful groups began to openly oppose him. On May 29, 1720, Law was dismissed from his position as Comptroller General of Finance and placed under house arrest. This decision further eroded market confidence, and the Mississippi Company's share price plunged by 46% by the end of the month. Public outrage reached a boiling point as the Royal Bank struggled to honor its promise to exchange banknotes for specie. Protests erupted in the streets, and British investors, sensing the impending collapse, began selling their Mississippi Company shares at a loss. This exodus further depressed the French stock market while boosting British stock prices. In a desperate attempt to stabilize the situation, the regent briefly reinstated Law, albeit with limited powers. This move provided only a temporary boost to the stock price, and the financial system continued to unravel. In the following months, the French government took steps to dismantle Law's financial system and restore specie as the foundation of the economy. By July 1720, a run on the Royal Bank forced it to suspend the conversion of paper money into gold. In September, the value of Royal Bank accounts was slashed to a quarter of their previous worth, and the price of Mississippi Company shares was reduced to 2,000 livres. These drastic measures led to massive losses for both banknote holders and shareholders, particularly those who had invested at the peak of the bubble. The situation was further exacerbated by an outbreak of the bubonic plague in southern France in August 1720, which heightened economic uncertainty and caused a further flight from paper money to gold. By November, all remaining banknotes were converted into annuities, effectively ending Law's experiment with paper money. The Royal Bank was closed on November 27, 1720. John Law fled France in December 1720, leaving behind his family and the wealth he had accumulated, which was largely tied up in real estate. The Mississippi Company was placed into receivership in March 1721, marking the final collapse of the bubble. Interestingly, even after the company's downfall, there was still some demand for its shares. New issues in July 1720 were sold at 9,000 livres, despite the market price being around 5,000 livres. This demand was partly driven by investors looking to offload their devalued banknotes. The aftermath of the Mississippi bubble had long-lasting effects on France. The French public developed a deep distrust of banks, paper money, and the credit system, preferring to hold gold instead. This lack of confidence stifled commerce for years to come, as credit became scarce. While the French state benefited from a significant reduction in its debt, many investors were ruined, with some going bankrupt. The collapse of the Mississippi Company also had international repercussions, as investors shifted their focus to the South Sea Company in Britain, inflating its stock price while the Mississippi Company's shares deflated. John Law, once celebrated as a financial genius, became a despised figure in France. He spent his remaining years moving between the Netherlands and England, attempting to clear his name and recover some of his lost fortune. He died in Venice in 1726, his wealth reduced to a collection of paintings and little else. The Mississippi bubble and Law's role in it left a lasting legacy, shaping the future of financial systems in Europe and instilling a deep-seated fear of paper money in France for years to come.